In the late summer of 2008, an investment banking behemoth boasting $639 billion in assets projected an image of unshakable financial fortitude, yet internally it was hemorrhaging cash and choking on toxic real estate. The public filings of Lehman Brothers painted a picture of a firm aggressively deleveraging, actively shedding risk, and successfully navigating the early tremors of the global financial crisis. But this facade of stability was not the result of shrewd market maneuvering. It was a manufactured mirage, a forensic illusion crafted through a highly specialized accounting maneuver designed to temporarily vaporize $50 billion in liabilities at the exact moment the world was watching. The instrument of this deception was not a forged document or a phantom offshore account, but a sophisticated exploitation of a standard financial tool, weaponized under the obscure internal moniker of Repo 105. This was a masterclass in balance sheet manipulation, a strategy that allowed the firm to technically comply with accounting standards while fundamentally misrepresenting its true financial health to investors, credit rating agencies, and federal regulators. The sheer scale of the debt concealment transformed a routine liquidity operation into a systemic threat, masking a fatal insolvency that would soon help fuel a global catastrophe. To understand the anatomy of this fraud, one must first dissect the standard repurchase agreement, commonly known as a repo. In a traditional repo, a bank borrows cash for a short period, often just overnight, by handing over collateral like government bonds to a lender, with a binding promise to buy those assets back at a slight premium. Because the bank is obligated to repurchase the assets, accounting rules dictate that the collateral remains on the bank's balance sheet, and the cash received is recorded as a short-term debt. It is a secured loan, plain and simple. Repo 105, however, mutated this everyday transaction into a deceptive weapon. By late 2007, the subprime mortgage market was fracturing, and the executives at Lehman Brothers were trapped in a tightening vice of market scrutiny. Rating agencies were threatening downgrades, and competitors were circling as the firm's leverage ratio, a critical metric comparing total debt to shareholder equity, soared to alarming heights. A high leverage ratio signaled extreme risk, a vulnerability that could trigger a fatal run on the bank. The directive from the highest echelons of the executive suite was absolute. The firm had to show the market that it was shedding debt, but selling off toxic real estate assets in a plunging market would mean realizing catastrophic losses, effectively committing corporate suicide on the open market. Instead of selling bad assets, the firm turned to its Repo 105 program to cosmetically alter the balance sheet at the end of each financial quarter. The maneuver exploited a specific threshold in the accounting rules known as Statement of Financial Accounting Standards 140. Under this rule, if a bank exchanged collateral worth at least 105% of the cash it received and surrendered control of those assets, the transaction could be classified not as a loan, but as a true sale. By slightly over-collateralizing the repo transaction, Lehman crossed this arbitrary threshold, triggering an accounting loophole that would change the course of financial history. The execution, however, required surgical precision and a willing legal accomplice. Because no law firm in the United States would issue a true sale opinion for these highly questionable transactions, the firm engaged in blatant regulatory arbitrage. Lehman Brothers routed the operations through its London-based affiliate, Lehman Brothers International Europe. There, under the more accommodating jurisdiction of British law, the prominent firm Linklaters provided the necessary legal letter blessing the transactions as definitive sales. Armed with this critical document, Lehman could legally remove the collateral from its books and use the incoming cash to pay down other liabilities. As the end of a financial quarter approached, a frantic, highly coordinated scramble commenced on the trading floors. Billions of dollars in assets were shipped across the Atlantic, swapped for cash, and scrubbed from the public ledger. To an outside investor or a regulator analyzing the quarterly earnings report, Lehman Brothers appeared to have miraculously reduced its debt load by tens of billions of dollars. The firm's leverage ratio dropped significantly, projecting a false aura of prudent risk management and financial discipline. Yet this newly pristine balance sheet was entirely ephemeral. The true sale classification was a legal fiction masking an ironclad obligation. Just days after the quarterly earnings were published to a relieved market, the repo contracts matured. Lehman Brothers was legally bound to return the cash, plus interest, and take back the $50 billion in assets. The debt instantly rematerialized on the internal ledgers, hidden from the public eye until the next quarter end. This multi-billion-dollar vanishing act could not occur in a vacuum. It required the tacit acquiescence of the gatekeepers. Ernst Young, the external auditor tasked with safeguarding the integrity of the firm's financial reporting, was intimately aware of the accounting practice. According to the subsequent bankruptcy examiner's report, the lead auditor was fully briefed on the mechanics and the staggering volume of these quarter-end transactions. Yet, Ernst Young signed off on the financial statements without requiring a single footnote disclosing the existence, let alone the magnitude, of the temporary debt reduction strategy. The silence of the watchdogs was briefly pierced by an internal voice of dissent. In May 2008, a senior vice president named Matthew Lee penned a whistleblower letter to management, explicitly warning of accounting improprieties and highlighting the firm's perilous over-reliance on Repo 105. Lee recognized that moving tens of billions off the books to manipulate the leverage ratio was not just aggressive accounting. It was a fundamental misrepresentation of the firm's liquidity. His warning represented a critical juncture, a moment where the disastrous trajectory could have been altered. Instead of halting the practice, the corporate machinery moved to suppress the threat. Executive management intercepted the warning, and while Ernst Young was informed of Lee's allegations, the auditor failed to rigorously investigate the specific claims regarding the quarter-end balance sheet manipulation. Shortly after stepping forward, Matthew Lee was terminated, officially swept up in a round of corporate layoffs. The internal investigation was quietly closed, the warnings were buried, and the firm accelerated toward the precipice with its deceptive practices fully intact. The illusion finally shattered in September 2008. The market's crisis of confidence outpaced the firm's ability to manufacture liquidity. When counterparties demanded more collateral and credit lines froze, the true, heavily leveraged state of the institution was exposed. No amount of quarter-end accounting gymnastics could generate the actual cash needed to survive a catastrophic run on the bank. The systemic vulnerabilities that executives had tried so desperately to hide became the very anchors that dragged the firm under. On September 15, 2008, the 158-year-old institution filed for Chapter 11 bankruptcy, the largest such filing in global history. The shockwave of the collapse instantly froze global credit markets, plunging the world into the most severe economic contraction since the Great Depression. The revelation that a pillar of Wall Street had essentially been operating on a foundation of hidden debt and accounting alchemy shattered whatever fragile trust remained in the global financial system. In the wreckage of the bankruptcy, the true anatomy of the deception was meticulously unearthed. Anton Valukas, the court-appointed bankruptcy examiner, produced a monumental 2,200-page forensic report that laid bare the mechanics of the scheme. The examiner's findings were damning, detailing how executives intentionally used the transactions for the sole purpose of balance sheet manipulation. Valukas concluded that there was actionable evidence that executives had breached their fiduciary duties by filing materially misleading financial statements. Despite the forensic clarity of the examiner's report, the aftermath exposed a disturbing reality about the architecture of white-collar law. Because the transactions technically complied with the letter of the Statement of Financial Accounting Standards 140, and because they were blessed by a British law firm, federal prosecutors struggled to build a criminal case that could prove intent to defraud beyond a reasonable doubt. The architects of the scheme successfully hid behind the shield of technical compliance, arguing that adhering to a flawed accounting rule could not be construed as criminal fraud. The scandal forced a reckoning within the regulatory landscape. The Securities and Exchange Commission, humiliated by its failure to detect the manipulation, pushed for stringent reforms. The Financial Accounting Standards Board was compelled to rewrite the rules governing off-balance sheet financing, closing the loopholes that allowed secured loans to be masqueraded as sales. The regulatory response aimed to ensure that the concept of a true sale could no longer be twisted to facilitate billion-dollar vanishing acts. Yet, the regulatory fixes offered little solace to the victims of the deception. The collapse, accelerated by the false confidence projected through these manipulated earnings, wiped out billions of dollars in shareholder value decimated retirement accounts, and triggered a cascade of job losses worldwide. The human cost of the 2008 financial crisis was staggering, measured in foreclosed homes, shattered pensions, and a lost decade of economic growth for millions of ordinary citizens who had never heard of a repurchase agreement. The quiet settlements behind closed doors hinted at the deeper systemic vulnerabilities. Ernst Young eventually agreed to pay $99 million to settle a class action lawsuit brought by investors who had relied on the manipulated financial statements, though the firm denied any wrongdoing. The state of New York also pursued civil fraud charges against the accounting firm, resulting in a $10 million settlement. These financial penalties, while substantial, paled in comparison to the global economic devastation wrought by the firm's collapse. The legacy of Lehman Brothers debt concealment remains a chilling testament to the dangers of financial engineering. It demonstrated how highly compensated professionals, armed with complex legal opinions and arbitrary accounting thresholds, could construct a reality entirely divorced from economic truth. The systemic vulnerabilities from that era persisted, proving that the most dangerous frauds are often those executed in plain sight. Repo 105 was not merely an accounting error, it was a deliberate, institutionalized mechanism of deceit. It stands as a permanent warning that in the opaque corridors of high finance, the most devastating threats often do not come from outright theft, but from the weaponization of the rules themselves, wielded by those entrusted to uphold the integrity of the market. The shadow of that intricate accounting still looms, a reminder that transparency is often the first casualty when a financial empire begins to fall.